Well, good morning to you all and greetings and Happy New Year. I hope you've all had a good break and ready for what should be another busy year ahead. I spent the last 2 weeks both teaching at the University of Flinders. As you know, I teach financial planning, and the week before at the Hong Kong Asian Financial Forum. That is their equivalent to Davos. We had 2,500 attendees, although sadly only 30 Australians. So a lot going on in Asia at the moment, that's for sure. One of the things we look at up there are global trends and, if I can say, concerns for the future. The immediate concern being the easing of QE3, or quantitative easing as they call it in the US. As I mentioned before, I see this as a positive thing. Bernanke, in his last statement earlier in the week, again has reduced the tapering by 10 billion. That's a positive. That's saying the economy is strong enough to stand on its own 2 feet rather than being distorted there. I have mentioned in my notes some of the emerging markets there's a bit of capital outflow there. Argentina, South Africa, Turkey. Turkey had to raise its interest rates 4% earlier in the week. So again, you'd expect there to be ripples in a thriving world, and there will be highs and lows again. But the general consensus being that the major trends I keep talking about, the growth of East, particularly in Asia, the technology revolution, which means we can communicate to a lot of people like this, people living a lot longer. These trends are not going to stop. And my graph and papers, they're just showing just how large a percentage of global population is in Asia. So the US really only 5% of the global world, so we need to consider where the 70% in Asia are growing. They're now becoming consumers. They're buying their own goods rather than exporting. And this should reflect on how we invest money going into the future. More locally, we're coming into the half-year earnings season. There'll be a few report cards that will disappoint. But in general, things are looking reasonably tight here, reasonably controlled. Definitely a move towards dividends and shares being one of the major reasons that investors are buying stocks, particularly directly. I mentioned in my notes again a trend towards, if I can say, new economies and out of old economies. So the obvious example being the decline of Fairfax and the growth of realestate.com, car sales, Seek, who've really taken over a lot of their classified work there. There will be quite a few new IPOs coming to the market. You'd expect that at this stage of the cycle, and quite a lot of merger and acquisition activities. This morning, the Fin reporting that DJs and Myers may be looking at a merger. In our practice, we're working hard as always, particularly on the website. Please do get involved and log in. There's a lot of treasure chest of really good information there, including external data and research for you to read. It is a great way of communicating with us. We need to be smarter and faster and quicker as a business, so more by SMS, more by email. It also helps if we do have any emergencies. If you're used to dealing with us by video, we can get a very quick message out to you if something major does happen. And you would anticipate once, twice a year a movement of maybe 5–10% either way in an equity market. So it is well worth trying to stay in touch with us. And based on the feedback I'm getting, we may in fact do these videos more often. So we may move to fortnightly or even weekly, depending on the demand there. So that's enough for me. Welcome to the year, and I look forward to seeing you all as the year progresses. Thank you.